Hi friends, do you know how many types of mutual funds in the market and how they are doing the allocations? If you don't know, this is the video for you. We will discuss types of mutual funds and how those funds are get allocations in each stocks. Welcome to our channel Stocks in Silence. First, let us understand that how the mutual fund allocation is happened in last 1 year. So generally the people, they will allot from one cycle to another cycle. The big investors, they will move from one sector to other sectors. So that is, we call it as a allocation. So before we discuss about that allocation of the each mutual fund, first we'll understand in last 1 year, that is from March 2021 to March 2022, what happened in that different types of mutual funds. First, let us see the debt oriented mutual funds. In this figure, the left side is the dark blue, navy blue is call it as a March 22, and the gray color we call it as a referred as a March 21 data. First, let us see the debt oriented funds. Almost 1,14,824 crores as went out. That means it's gone from the fund people are taking out from this debt oriented funds. Last year it was 52,528 crore, but this year it becomes 1,14,824 crore people take out from the debt oriented funds. When we see that equity oriented funds, last year it was 9,115, this year 28,463. It looks like that people are putting more fund in that equity oriented funds. When compared to March 21, March 22, 212% change, that is positive change. In debt oriented funds, minus 119%. Then let us see that hybrid funds, last year it was 6,210, now it becomes 3,604. That means here also minus 158% down when compared to the last year. So this is very important data. We have to understand how the fund managers and the people take it or close it, or how they are entering in the new funds. Next, equity funds everybody knows, but how they are allocating. Many people believes that if it is large cap, people don't know, they are believing that all the funds whatever they are putting in a large cap, it goes for only in large cap. No, that is not a true. See one by one. Large cap, at least 80% in large cap, remaining 20% they can allot as per their fund manager's wish. If you see the number of large cap funds as of today, 144 funds are there. Same way if you go for large and mid cap, at least 35% each large and mid caps, that is a compulsory. Remaining 30%, for example mid 35 and large 35, it is a compulsory. Remaining 30 they can allot as per their wish. So number of funds 30. Flexi cap, the name itself it indicates there is no limitations for that. You can play either large, mid or small as per your wish. Number of shares as of today, 70 funds are there in the market. Mid cap, at least 65% should be in the mid cap. Same way in small cap, at least 65% in the small cap. Mid cap, if you see 39 funds are there. Small cap, if you see 40 funds are available in the market. Then another one is multi cap. You can choose whatever the funds, but the limitation is at least 25% in each large, mid and small caps. The number of funds is 21 as of today in the market. Next one is value oriented funds. The people choose only the more value oriented funds, that the fund managers call it as a value oriented funds. Number of funds available as of today is 22. ELSS, everybody knows, that is equity linked savings scheme, the tax savings fund. Here also there is no limitations. They can play as per the proportion across large, mid and small. Number of funds 57. The sectoral thematic, here it's very important. At least 80% in particular sector or theme. For example, if you would like to put it in the IT sector or pharma sector or a public sector unit, then at least 80% in the particular sector. If you see the number of funds, 167 funds are there, so it looks more demand on the sectoral and thematic funds. The last one is international or foreign funds, more than 65% in foreign equities. We believe that whatever the money we are allocating in foreign funds, we believe that 100% goes to the foreign funds. No, that is not a true. More than 65%, it's a compulsory. More than 65% means they can go up to 70%. After that, remaining 30% also they can put it in the other Indian funds and other whatever the funds they likes. So the number of funds, if you see, 67 funds as of today. So now we are seeing that how the equity funds and what are the names and what are the allocations in this page. Next, same way, if you see the debt funds, there are different names and different durations. Here generally based on the duration they are putting the names. Long durations means more than 7 years, medium to long duration means 4 to 7 years, medium duration means 3 to 4 years, short duration means 1 to 3 years. So number of funds I have given, almost more than 30 funds are available in each sections. Again, shortly we can understand if it is 1 to 3 years, it's a short durations, 3 to 4 years, medium durations, 4 to 7 means medium to long, more than 7 years means long durations. So these all duration based debt funds. Then apart from that, money market also there. Money market instruments having maturity up to 1 year. If the maturity period is 1 year, money market, you know, it may be dollar or rupee or yen or whatever that money related, we call it as a money market debt funds. Then low duration is 6 to 12 months only. Here again that around 20 to 25 funds are available. Ultra short durations, that is also there, that is only just 3 to 6 months. Number of funds, 29 funds are available in the market. Then liquid funds again only just 91 days, 41 funds are available in the market. Overnight funds, overnight means within a day it will get matured, the duration period is just 1 day. Here also around 30 funds are available. Then dynamic bonds, they will invest only in the bonds, that is around 32 funds are available. Corporate funds, there are two types, one is high grade and low grade. Here the corporate bond, it's called as more than 80% only, they will put it in the AA plus rated funds. AA plus means CRISIL, they are given the ratings, AA, BB, AA plus, AA plus plus, like that. As I hope that you may aware about that ratings and all. So here 80% they are putting AA plus and remaining they can put it in the other markets. The next one is credit risk. Here they are putting 65% AA, not a AA plus. The remaining they can put as per their wish. Here also around more than 20 funds. Credit risk 26 funds and corporate bonds 23 funds are available in the market. Banking and PSU, you know that name itself it indicates 22 funds are available. They will put mostly on the banking and PSU banks. Then floater, the name is called floater funds. Here the interest rate may float, it's not a fixed one. Those funds, those type of bonds, they will allot their funds in there, that is called as a floater. Here also around 12 funds are available in the market. The next one is gilt, GILT, that is called at least 80% in government sectors. Then gilt with the 10-year constant duration, here also at least 80% government bonds, and then the lock-in period is 10 years. Here also 5 funds are available in the market. The last one is FMP, fixed matured plan. How we have seen that floater is opposite to floater, we call it as a FMP funds. Here the investment and predefined term, that means the fixed rate, fixed durations. Here if you see the numbers 322 are available in the market, so it looks more demand for the FMP funds. So that's all, these are all about the debt funds. Next, you know that once if you know that hybrid is nothing but the mixture of equity and debt markets, and many hybrid funds also there, we will understand one by one. First one is aggressive hybrid funds, 65 to 85% in equity and rest in debt markets. Number of funds are available 49. The balanced advanced hybrid funds, call it as a 40 to 60% in equity, remaining in debt market. 5 numbers are available in the market. So balanced in the sense, like for example, if you see the difference between aggressive hybrid and balanced hybrid, the number of allocation in equity is varies. If more numbers in equity is call it as a aggressive and less number is balanced. Obviously the next one is conservative. Again they will reduce the number of allocations in equity, that is only 10 to 25% equity. The remaining debt market we call it as a conservative hybrid. The number of conservative hybrids are again 55 funds are available in the market. Then equity saving, at least 65% equity, remaining 15% in debt. Number of funds are available 24. Arbitrage, that is investment in only in arbitrage, number of funds are available 25. First we should understand what is arbitrage. Arbitrage is nothing but the difference between the cash market and future market. If you take one stock, there might be the difference in value, price compared to cash market and future market. Same way, if you see the price in stock exchange of BSE slightly differs from the price in NSE. So this we call it as a arbitrage, the price difference between one exchange to other exchange and cash market to future market. We call it as a arbitrage. Here also arbitrage funds are 25 funds are available in the market. And dynamic asset allocations, again, the name itself, it indicates that dynamically you can play wherever you want to put your allocations. Number of funds 29 are available. The last one is multi-asset allocations. Of course, the multi-asset is at least you can able to put 3 different asset allocations, but at least in each sector or each assets classes at least 10% you should allocate. This we call it as a multi-asset allocation. Again, 23 funds are available in the market. Apart from equity, debt and hybrid, some more funds, that is call it as a IPO fund. This is very interesting. Edelweiss running from 2020. Here they are putting only the IPO related funds. Whatever the IPO comes in the market, that dedicatively they have that mutual fund allocations. Here there is no percentage of allocations. So whatever the IPO, they keep it as a separate fund team. From 2020 to 2022, it's going well. Apart from this Edelweiss, I hope that the BSE also they have the IPO fund. If you see the data, 2020 around 250 crore, even 2021 middle of June, July it was around 250, but after the June it went up to 1000 crores. It indicates that many IPO funds people are interested and many IPO also came to the market. The fund size is increased, but in 2022 after February slightly decreased. So this obviously we have to see after the long time, because we don't know how that IPO funds may behave or will give the return after the long period. But till now it hopes that at least 50% of funds performed well and remaining 50% flopped. So this also one of the opportunity if you would like to invest in the IPO related funds, because many people they are interested in IPO but they may not get the allotment. Those people they can concentrate on these IPO related funds. Last one is commodity. Gold also the separate ETF funds. Many funds are there. 21 funds are available in the market. Silver also separate ETF funds are available. Recently 2-3 months back they got approval from the SEBI. So ICICI and other people are there in the market. Around 6 funds are available for the silver also. So now we have seen there are different types of mutual funds, equity, debt and hybrid, commodity and IPO related. Now the basic question is, who would like to enter in the mutual fund? So you can say, sir, I don't have time to watch the market and even I don't know how the market is functioning. Sometimes it goes up, sometimes it goes down. So I don't have that capability to monitor and even I don't have the time. But I have some amount I would like to put in that any saving schemes, either it should get more than that fixed deposit. For those people, mutual fund is the best one. And some people, the people would like to get, and people like to wait for a long time. They want to protect their capital at the same time. They want to get the benefit of that debt market and equity market. That means the constant increment in their investment. So those type of people, the mutual fund is the best one. So always you will not get loss in mutual fund over the long period. Not only the loss, you will get the reasonable appreciations in mutual funds. So now why do we go for the balanced one instead of going for equity, instead of going for debt? Why do we go for the balanced one? That's a valid question, because so every positive have the negative energy. Same way, if you see that the equity market is a highly volatile, it may go up and down. Again, we could not able to understand the cyclic behavior of the market. Sometimes due to the inflation, some sectors may go up, and due to other reasons in other times some sectors may go up. We don't know how to balance it. So you no need to worry, fund managers will take care. That is a fund, they call it as a balanced advantage fund. Here if you see that figure, how we are running, or when we walk above that rope, we are just balancing our hand right and left. Same way, some portions in the equity, some portions in the debt, so we can balance the volatility. So there is a major benefit when we go for the balanced advantage fund. Even some people, you see the figure, that lady is running a cycle over the rope. So just for a fun, If you know how to balance it, definitely you are going to get the more benefit over the long time. And compared to simple equity and simple debt, the mixture of equity and debt will be the best options. How it is functioning? So simple is a very easy. Suppose if the market is more valued, the market is very high, they may not put more allocations in the equity. At the time, they will put less allocation in debt and more allocation in equity. Suppose if market is more value, that means it may go down. So in that situation, they will get more allocation in the debt, less allocation in equity. So it depends on the situations. What we are understanding is both are opposite. If equity market is high, the return from debt market is low. If market is down, definitely your debt market is going to give more return. So in that case, they will balance. The people who are expert, they know how to balance it, how to allocate. According to that, they will behave and they will do the allocations. Then ultimately, the investor is going to get benefit. So this is what that figure right side it shows. It's very easy, simple to understand. Finally, this is very important. If you go for any mutual fund, we have to understand that what is the expense ratio, because expense ratio in 1 or 2 years it may not looks big, but over the long period of time, like more than 10 years, 15 years, 20 years, the amount which goes as a expense will be the very high. The people who are new to the expense ratio, it's very simple to understand. It is nothing but the amount we are paying for the fund managers to maintain our funds properly, because they is going to manage, and definitely some charge will be there for the fund manager, that we call it as a expense ratio. If you see that each fund, the first one is flexi cap, large cap, aggressive, and mid cap. If we see the colors in the first graph, the first gray color is the flexi cap, light blue color is a large cap, and navy blue is aggressive hybrid, the black color is mid cap. Expense ratio comparatively for flexi cap, large cap, aggressives are more very high for the large cap. So this also we have to note down when we go for any mutual funds. The next one is, okay, we have seen equity is better, or debt is better, or hybrid is better. So altogether we understand that the people who would like to get long-term steady growth and steady return, either aggressive hybrid fund and balanced advantage fund is a more suitable. We have seen that aggressive and balanced, the difference is more allocation in equity, we call it as aggressive hybrid. 50-50 or less allocation in equity, and another allocation in debt, we call it as a balance advantage. Okay, so here both are equity and debt, we call it as a hybrid. The percentage of equity is more or less, that's why we call it as a balance or aggressive. So when both are fine, but if you compare the both over the long period from January 2014 to February 2022, when we compare, balanced advantage funds has given good return comparative to aggressive hybrid fund. So finally, what we are going to decide is, as we have started the video, I have seen one of my friend's portfolio. He is investing 20,000 in every month, but when I see, he is having almost 14 number of mutual funds in his portfolio. Even he doesn't know what he is doing. He said that some mid cap, some large cap, some small cap, and same type of mid cap in another asset allocations. For example, one in mid cap in Motilal Oswal, another mid cap in ICICI, another mid cap in HDFC. Like that, he mixed up all things. It's really required 14 funds in your portfolio. If you ask me, I will say no, because it's very simple. Most of the funds, they are choosing same type of stocks. Even if you go for IT stocks, most of the IT index or IT related stocks are playing with the 4, like HCL, Wipro, Infosys, or Tech Mahindra, like that. 4 or 5 major stocks only there. 80%, 90% of the allocations goes for those stocks only. So if you think in that angle, what are the minimum and very good mutual funds in your portfolio? The first one I will say, let's say index fund, because index, for example, if it is NSE, the main stocks in NSE are comes in that index fund, and again the expense ratio is very less. So over the long period, index fund is will be the best options. The growing country like India, at least averagely 10% return in every year. Even the worst case we can consider say 7 to 9%. So index fund, one index fund is required in your portfolio, agree. The second one is flexi cap fund. as we have seen that flexi cap, the people would like to get benefit of mid cap and small cap apart from the large cap, then they can choose one flexi cap in their fund. For example, if they keep one flexi, at least 60-70% large cap, then remaining 50-50, that means 15% small and 15% mid cap. So they will get the benefit of that return of other sectors or other category also. So another option is we can keep as a second one is a flexi cap. Third one is, as we have discussed, either you keep as a aggressive hybrid fund or balanced advantage fund. So this will be the third category. The last one is, of course, we need one tax saving fund. So we can either keep one tax saving fund, or if you have more money, I don't bother about even the ups and downs in the volatility, then you are ready to wait for long term, then you can keep at least one small cap fund, because every company, one of the time it was small, then it has grown up like Infosys. So we don't know which small cap fund will hit in the market after over the long period of time. So at least you can keep either one small cap fund or tax saving fund. So these four category will cover the entire mutual funds. I hope that more than four of this category is not required, and again it's going to be repeat if it is more than four in this category. So I hope that this video is very useful to you. If it is useful, please subscribe, and if you like that video, please press like button. If you have any comment, put it in the comment box. Thank you. Bye bye.